Good evening. I am Sensei Kevlar. Welcome to the Dojo. Thank you all so much for taking the time to invest in your future profitability. I'm going to spend a little bit of time this evening talking about why it is that I brought you here and what it is we're going to be doing, and a little bit of time also talking about what it is we're not going to be doing, because that's kind of an important aspect of this. Before I actually move on to the lesson plan itself, and I hope that you stay with me for the next 3 weeks as we explore trading and automation and group planning. What it is I'm going to be teaching you is a trading technique called allocation-based planning, or planning for short. You'll hear planning spoken about a lot. The idea behind allocation-based planning is that you allocate your opportunities for different markets in such a way that you are always assured a return on those opportunities, assuming that they follow certain conditions. And what I'm going to be showing you is how to map out those conditions and how to figure out how to identify those opportunities, plan your allocations, and trade those investments in a way that's profitable. And I'm going to teach you how to do it without spending any money at all. And that's the first thing I really want to address right now. I'm not asking for your money. More to the point, this is not trading advice. This is not financial advice. What I'm going to be trying to show you is something that should be scientifically demonstratable, which is to say that you can test it, you can observe it, you can try it over and over again and see that it works repeatedly. I'm going to increase the volume here just a bit. You can see that it works repeatedly over and over again without spending any money. I'm going to teach you the art of paper trading, which is the art of figuring out how to trade without actually spending the money to trade. And then once you have figured out how to trade on paper and make yourself profitable, that's when you can go and take your money to the market. So the first thing that I need to do is I need to ask of you right up front. The first rule of Dojo and attendance in these classes is that you stop trading. If you take what it is I'm teaching you, if you take this lesson or any lesson that follows and you go immediately and you then go to the markets and you start trying to apply it using actual money, you will not succeed. The entire idea is that it works in conjunction with all the methodologies. It's like any martial art. You can't just know how to punch. You have to know how to punch and kick and block and duck and weave and dodge and do all of those things. So it's really important, and I really want to get across to you. If you take what it is that I'm teaching you and you try and you try and make money with it without having actually watched through all of the techniques, without having actually practiced the techniques that I'm showing you, without having actually spent the time learning how to paper trade, without actually having spent the time learning how to prove to yourself scientifically, repeatably, independent of anything that I am saying, that you can be profitable, you are not following my instructions. You're not listening to what I'm saying. You're not doing what it is that I'm saying you should do to be profitable. So I ask of you now, if you are in a situation where you're actively making decisions and you're able to stop making those decisions, you're able to stop trading, the result of that is that tomorrow you'll still have the same amount of Ethereum that you did yesterday. Nothing is going to change. The risk is that you actually try and apply what it is I'm teaching you, and you don't apply all of it in a methodical way, and that's how you lose money. And I don't want to see that happen. So the rule of Dojo is stop trading, and the reason is because we're going to learn how to do it correctly without spending money. I really want to stress that, and I want to get that across to everyone. While we're on the subject of money, I also want to talk about why I'm not charging for this information. Most people will ask for your money for their time. What I'm doing is I am building a group of professional traders who know how to trade. You see, trading is a game that is information based. The better your information, the better your investment strategies will become. What that means is that consolidating information, people, and the tools that empower them into a single place enhances my own ability to trade. It also will enhance the other people who are participating. Together, if we work together to talk about our trades and to show our strategies to each other and to help each other learn and to help each other identify these opportunities and to help each other strategize about these opportunities, this is a win for everyone involved, and nobody has to give any money to anyone else. And so that's why I do this. That's why I teach people how to trade, and I don't ask them for money in doing so. I don't even ask for money to use the automation. Again, because actively using the automation will enhance the information available to everyone participating. Now, I want to get clear that this is not a pump and jump group. This is not a situation where we will be calling out opportunities and giving you the opportunity to invest in them and then doing something later like trying to make them go up. That's just not how this works. What we're going to be doing is we're going to be studying actual techniques used by actual traders and how to do allocation-based planning to ensure your profitability on paper. That's what we're going to be doing. You can take this knowledge and you can apply it to any market. You can apply it to Forex. You can apply it to stocks. You can apply it to crypto. You can apply it to anything with a chart that goes up and down. But I want to make sure that we're all on the same page about why it is we're here. We're here to learn how to trade. And then we're going to participate as a group in trading. And sometimes, what that means is that means sharing information, sharing what it is you're doing, sharing the learning that you're receiving, sharing the strategies that you're doing. And what I intend to do is I intend to prove to you scientifically, which is to say that you can repeatably observe it and test it and verify it independent of anything that I am saying, that working together as a group increases profitability, it increases opportunity generation, it increases the amount of times at which the opportunities turn out for the better. It increases our ability to profit. But what we need to do is we need to start with a foundation. We need to start with a foundational understanding of how to profit, of how to ensure our profitability, of how to build a strategy together in such a way that we all understand what it is we're doing and we all can take individual responsibility for the risk of doing it. I am not telling you how to trade. I am telling you how to allocate your money for your investments, and this is math. Either you can do the math and the math works out, or what I'm saying is wrong. There are no two ways about this. I am not going to show you how, a way to predict which way the chart's going to go. Anyone who's trying to sell you on a signal is a fraud. Anyone who's trying to sell you on a way to trade that says, when the market does this, then you do this, it's a fraud. There's a scam. They're trying to take your money. Okay? Allocation-based investment does not work that way. It works by carefully planning your allocations and managing your money in a way that makes sense, that's mathematically demonstrable, to keep you profitable. That's how it works. And so that's what we're going to be spending the next 2 weeks focusing on, about how to make that work for us. And the format is that we're going to do the 8 o'clocks Monday, Wednesday, and Friday. And then in 10 o'clock the next morning, Tuesdays and Thursdays, we'll do live charting sessions in which we'll take the lessons from the previous day and apply them to live charts, to actually see those strategies applied live to the market, and we'll paper trade our way through the lessons. So let's get started. What I'm going to do is I'm going to pull up one of my favorite trading sites or charting sites. Now, I'm not making a recommendation that this is the product you have to use. It is a paid product. I do happen to pay for it, but I don't recommend that you do. I recommend that you start on the free tier. I recommend that you explore as many tools as you can in order to make yourself comfortable with the information that you are getting. I'm just going to show you how to use TradingView because it happens to be the one that I use. What I'm going to do is I'm going to pull up a chart for ETH USD. I'm going to take a look at the Ethereum dollar chart. Now, I apologize because for some of you, this is obviously going to be a review. What I'm going to do is I'm going to click on the full featured chart. And I'm going to explain to you what the hell we're looking at right after I clean up the screen. There we go. Okay. And we'll get rid of this information, and we'll get rid of this information. Okay. This is basically what most people are going to look at when they see the information come up on their screen. They're going to see a chart that's at the day aggregation. So what we're seeing is a candle. And what the candle represents is the candle represents a day's worth of price information. If the candle is green, what that means is that on this day, the market opened right here at the bottom of the candle. Then at one point, it came down, the price came down all the way to here, to $194, before it shot up in the middle of the day to $242 before sinking all the way back down to close at the end of the day at $214. Okay, so this one candle, this one piece of information in our chart is showing us 4 different pieces of information. It's showing us the open, the low, the high, and the close. Okay, open, low, high, close. We call these wicks on top of the candle. Now, what I want to point out to you is that this is an aggregate of information. We're taking the information and we're rolling it up. If we take this information and we roll it up a little bit differently, it's going to look a little bit different. Okay. What I did there is I changed the aggregate information to 4 hours. So instead of a whole day per candle, I'm showing the price action for a 4-hour time window. Okay. Now, most of the stuff that we're going to be looking at is going to be on the 4-hour chart or more. Anything lower than the 3-hour chart, you're just seeing a lot of market noise. You're seeing a lot of price action that isn't relevant to what it is that we're actually looking for. But I want to point out something that's very interesting. These markets, they tend to move in very specific trends. Let me pull back out to the day chart. They tend to move in very specific trends. They tend to move in such a way that that when the market goes up and then comes back down, if they revisit that price, it tends to then turn around at that price level again. Here's an example of what I'm talking about. Here the market was going up and going up and going up, and when it reached $385, just, touched $400, just shy of $400, it started coming back down. Well, the next time, and again, this is on a day chart, so each one of these individual lines represents a single day. This is over, 30 days. This is a month right here, right? This is June, July, August. Well, you see what happened is when it came up again, it stopped right at the 385, 390 mark, and it turned around again, okay? So we have words for this that we're going to be using when we talk about these things. A lot of this is going to be terminology, and a lot of it, as you will learn later, is going to be about changing your vocabulary. So I recommend that you start using these words to describe these patterns, okay? Because what we're trying to do is we're trying to do a little bit of pattern recognition. And then we're going to explain scientifically what it is we're actually looking at, okay? What I did is I came over here and I chose a drawing tool to draw on the chart. I chose the horizontal line drawing tool. I'm actually going to choose the horizontal ray because it starts in the past and then extends into the future without extending into the past. By choosing this, what I can do is then I can just put my mouse right here on top of this and I can click. And what that'll do is that'll extend a ray into the future. And what I want to point out is that when it came up, it experienced some resistance right here. and then it came back down. And then when it came back up again, it experienced resistance to going up at exactly the same point. Right here. See how it just came up and touched that line, hit that resistance level, and came back down? Okay. Now, something else happened here. Right here, the same thing. We were going up and we found some resistance. Okay. So I want to make a point of calling out that slightly smaller resistance right here, where we turned around at $186 and crashed back down to $150 for a couple of days. Okay. Crashed back down to $150. And when we crashed back down to 150, we found support. Because what happened is the market started buying at this level. It said, you know what? I really like this level. I think I'm going to buy Ethereum, and that caused the price to go up. Okay, so I'm going to put another line here. I'm going to point out that this is resistance and this is support. When the market's coming down and it turns around, we call that support because the market is buying more and the market price is going up as a result. Later, what happens is the traders get profitable. They go from $152 to $387. Well, that's a big price increase. So what happens at that point is they get greedy. They want to lock in those profits. So what they do is they start selling, and then the price comes down again. Okay? Well, what happens is when it gets to this point right here, the traders are looking at the past. They're looking at where the support previously occurred. They're looking at where the resistance previously occurred. Previously, support was found right here. This is where we turned around and we went back up. Then we turned around again right on the support line. We went back up. How far did we go back up? To the resistance line. Then we went down again. Then we went up and we broke through resistance. Okay. Then what happened? After we broke through resistance, what was the next thing that occurred? Resistance became support. Okay. Here, we were going up and then we broke through resistance. Well, as soon as we were coming down and we wanted to turn around, we found support where? At the previous resistance line. Okay. This is a trend that you will find repeats itself over and over and over again. And it's this trend that is demonstratable within the market scientifically. You can capture the percentage of times when resistance was respected, here and here, versus when resistance was broken, here. You can also capture the number of times when resistance became support. Here, resistance was found twice. Here, it became support twice. Here, it became support again. Here, we didn't quite reach the support line before turning around and finally crashing back down to the support line. Okay. Now, later on, what happened is we kind of puttered around in this sideways range right here, and then we got down to what was previously expected to be a support line. Traders were predicting that this would be a support line. So what happened is when it got to here and it crashed back down through the support line, look at this right here. This is the volume. This is how much money is actually going into this market and doing the buying. Okay. And what you're looking at is a massive increase in volume. Look at how high this volume is. Let me project that horizontal ray back into the past. No, it's not going to let me. That's all right. You can do it with my mouse cursor. The last time we saw that much volume was in February of 2018. Okay. What was happening back in February of 2018? We were coming down hard. Okay. So the same level of volume that was able to push this market down this hard came in as soon as it dipped below the predicted support line. Then what happened? Well, it popped right back up right above the support line. Okay. Now at this point, what we're doing is we're simply mapping correlations. We're simply measuring probabilities. We're simply measuring the times at which it did versus the times at which it didn't. Okay. And if we could know that the market was always going to respect support, or always going to respect support in coming down, we would simply buy right here. If we knew that the market was always going to respect resistance, we would sell right here. And this time we would have been right if we had done that based upon this prior resistance level. But this time we would have been wrong. Now, interestingly, it did become support, which means this 390 level, this 400 level, is very heavily correlated. Okay, but then so is this 150 level, very heavily correlated. You see, as soon as it dropped beneath it, we pop back up, giving us some more correlation against this level. So, what can we do with this information? Well, what we can do is we can start to apply a notation of allocation and of allocation for our opportunities that will allow us to take advantage of these motions within the market. These motions within the market that are measurable with a degree of probable statistics. Okay. And then what we can do is we can devise a strategy that optimizes for the times when resistance is respected, but still takes advantage of the times when it isn't. Likewise, we can create a strategy which optimizes for the times when support is respected, like it was here, like it was here, like it was here, but does not completely screw us and take our money when it doesn't, like it was here, where support was not respected. So in order to do that, we're going to introduce a new concept, and here's the way it works. It's called dollar cost averaging. The way dollar cost averaging works, I'm just going to bring out my calculator here, is if you buy something for $100 and then you buy something for $50. Oops, sorry, too many there. You buy something for $100 and then you buy something for $50. You spent a grand total of $150, but you now have two of the thing, which means that your total cost for each thing is $75. Okay. Now let's see if we can apply this to the real world. If the market was here at 150 and we bought a single Ethereum, and then we came down and it came down to 50 and we bought a single Ethereum, well, then we would have two Ethereum and they would be worth $75 each. Okay. What would happen is now, because each Ethereum is worth $175 each, our profit is the difference between $75 and the current market price, which is $153. What that means, excuse me, what that means is that if the market goes down, what we need is we need more money in order to ensure that we can dollar cost average our price down. This is the foundational aspect of the allocation strategy. You might recognize it from popular betting sites as the martingale. The problem traditionally with the martingale system, when dealing with a strategy for placing bets or dealing with a strategy for investment, is the martingale system has a limit, and that limit is your bankroll. The same system applies here. However, the difference is that we know what our bankroll is. More to the point, we know what the maximum it can actually go down is. And that is the reason why martingale does not work in a betting strategy, is because the number of losses can be unlimited in a betting strategy. In a market, the number of losses is limited. There is a finite number. There is an actual limit that we cannot exceed with regards to our losses. And that limit is 0. It's delisting. It's when the market goes away entirely and they lose all your money in that opportunity. Okay. So the first thing that we need to recognize is we don't want to do that. We don't want to buy into a market that's going to go to 0 and get delisted. But every other market that's out there, well, that's valid. That's fair game. Why? Because if we know what the martingale system is, and we know what the limit of that martingale system is, we can project what our maximum allocation will be at the bottom of the market, and then work backwards from there. Okay? If we knew here that we're buying at $150 because we think we're at the resistance line, but we know that sometimes, we're at the support line, but we know that sometimes this support line isn't respected, then we know that we need to have more money coming down to here. And assuming that it comes down here and then it continues to go down, we know that we're going to need to have more money for when it comes down to here, to $25. Okay? And if it goes down more from there, we know we're going to need to have more money down to $5 or $10 or wherever your next point is that you think it's going to go down to. Okay? The maximum lower limit here has got to be something. It's got to be 1 penny. It's got to be something. It's got to be a number. Based upon the idea that that number forms our limit for our dollar cost averaging, we can effectively dollar cost average any opportunity. Simply by saying, well, I don't want to spend more than $1,000 on this opportunity. And if I want to have spent $1,000 on this opportunity, and I want to have doubled up at each point where I think the market could turn around and give me an opportunity, well, that means that I need to have spent $500 here, and I need to have spent $250 here. I need to spend $125 here. I need to spend $75 here, and I need to spend, 38 and change or whatever it works out to here. Okay? Because what I did is I came in here and I mapped each and every point that I actually wanted to try and take advantage, that I thought the market could turn around. And when the market came down and it touched those points, I bought in. How much did I buy in? Well, if I allocated $1,000 for down here, then I can work backwards to 2xing 500, 250, 125. How much did I buy right here? $125 worth. I hope I haven't lost anybody with that math. The idea here is that even if the market does not go down or go up to where it previously was, as it clearly hasn't in this case, if we bought at 150 and then we bought at 50, we can make money as soon as it goes above 75. That means it never returned to 150. Yet we're making money above $75. Okay? All that is required of us is actually doing the allocation and the planning as the market comes down for our buying. So, how do we do this? Well, this is what paper trading looks like, right? The first thing we're going to do is we're going to say, all right, well, let's make a plan. Pull out your handy dandy notepad. Okay. First place I'm going to buy is $150, and I'm going to buy, I'm going to spend $100 worth, right? The second place I'm going to buy is at $100, and I'm going to spend $200 worth. Okay, so that's a grand total of $300. Okay, the next place I'm going to buy is at $80, and I'm going to spend $400 for a grand total of 400 plus 200 plus 100 is $700 worth. Okay. Next place I'm going to buy is at $65. I'm going to buy $800 worth, right? 700 plus 800 is $1,300. Okay. What that means is that I have planned for the market to go all the way down to $65. And I have allocated my money for this opportunity. If this market continues to sink away from me, well, all it has to do is go up 50% of what it lost, and I'm in the profit. Okay. Now, what we can do is we can actually test, did that make us money? Did that, sorry, 1,500. My bad. Thank you. What we can do is we can actually test, did that make me money? Did that actually work? Did that actually work if I doubled up here and then I doubled up here? Would I actually be in the profit? Well, I think what you can see is that, from here to here, yeah, maybe you would have made a little bit of profit if you sold here, but not a lot, right? And yeah, you probably could have made a little bit of profit right here if you bought here and doubled up here. Maybe not a lot. Because the 50% mark on that, it's not a lot, right? We're not high, we're not very, I'm just going to color this a different color here because I'm trying to show the 50% mark of, if I bought on this red line and then I bought again on this red line, this is the 50% mark. So I'm a little bit in the profit, but not a lot. So what could we do to maximize our profit? Well, one thing we could do is we could buy more. Okay? Rather than doubling up, here I could triple up. Well, if I triple up here, then I need to triple up here, right? That becomes 900, right? And on and on and on. And you can see that now I've spent more money. You can see that now I've spent more money at the bottom of the market here, right? But what happened is because I was dollar cost averaging, right? If I bought my first thing at 100 and then I bought two things at $75, well, I now have a grand total of three things. I've spent $250. But instead of 100 plus 70, yeah. So instead of averaging between halfway in between 175, we've now brought it up to 83.3. So what we've done is we've actually we've brought this number down here, right? And if we buy more, right, let's do the math. We do 100 the first time, plus 75 plus 75 plus 75 divided by 4. Now we brought it all the way down to, I think I screwed that up there. Let's try it again. 100 plus 75 plus 75 plus 75 equals. So now we spent $235, and then we need to divide by 4. Okay. I think, I definitely screwed up the math at this point. Let me do it one more time. There's the problem. 100 plus 75 plus 75 plus 75. There we go. Divided by 4. Okay. So previously we were at, $83. Now we brought it $83.3. Now we brought it down to $81. Okay. What we're doing is, each and every time, oh my goodness. Each and every time what we're doing is we're creeping down where our profit point is, right? And if we do it again, if we do 100, not times, 100 plus 75 plus 75 plus 75 plus 75 equals divided by 5. Okay. Now we brought it down to 80. We've crept it down, crept our profit line down even lower. And now we're profitable above $80. Okay. So this is testable. This is not something that you need to spend money on to figure out. This is not something you need to spend money on to do the math. To figure out how much money you're going to have allocated at the bottom of the market, to figure out how much money you want to have spent coming down here. There's no money involved. This is all just math. And either you can sit here and look at the chart and figure out where the support and resistance lines are and do the math to figure out how much you're going to spend in order to make yourself profitable and how you're going to be profitable, where you're going to be profitable. You're going to be profitable above $80, or you're going to be profitable above $85, or what it is you're going to do and what that does to your profitability. You can do it all on paper. This is called paper trading. And the idea is that you can build a strategy on paper that always makes you money. No matter what the market does, no matter how small the correction is after a dive, if it comes down 90% and then gives back 10, can you do the math to make yourself money? How much money did you make? This is testable. This is repeatable. This is something you can do all on your own, and you don't need me. There's no reason that anyone shouldn't be able to just sit here and dollar cost average their way on paper. You should not do this on the exchange. But let's say I actually did want to execute this strategy. So I've gone through all of this and I've really felt strongly. I've done the math and I've came through and I've drawn all the correlations. I've figured out the statistical likelihood of it turning around, and I'm willing to put my money down, and I'm willing to bet that it's not going to go any lower to this, and I'm hoping it's going to turn around here. So I'm doing my buying here, but I'm planning to buy here and I'm planning to buy here. And I've got money allocated for that. Well, the next question becomes, when do you sell? Do you sell when you're 10% in the profit? Do you sell when you're 20% in the profit? Do you sell when you've made $5? Do you sell when you've made $500? How much do you sell? Again, this is something that you can test. This is something that you can actually figure out on paper. If I sold this much here, how much would I have made? Figuring out your profitability costs you nothing. Developing a strategy that makes you profitable costs you nothing. So what we want to do is we want to actually execute this strategy now in theory. So what are we going to do? What we're going to do is we already have the numbers. We know that at 150 we're going to buy this much, and we know at $100 we're going to buy this much, and we know that at $80 we're going to buy this much, and we know that how much of the money we're already going to have pre-allocated for this opportunity. We can just go ahead and go to the exchange and place the orders. They're called limit orders. What you do is you type in the price that you want to buy at and how much you want to buy at that price, and you go ahead and put your orders into the exchange. You put in the order for 150, you put in the order for 100, and you put in the order at 80. Then you walk away. You come back the next day. You see if any of your orders got hit. This is fearless trading. This is a way of making trading unemotional. This is critical. Trading should not be based upon your feelings. Trading should be based upon math. Trading should be based upon science. Trading should be based upon observations that you can repeat over and over and over again and always get the same results every single time. And that is the way of the trader. We've got a long ways to go with regards to this because there's a lot more to understand. But what I want you to do is I want you to take a look at your favorite charts. Go take a look at your charts and go and find your resistance and support lines. Draw them on the screen. Draw them on your charts. And then go and make a plan for how you buy those support lines and then sell them for profit and see how much profit you could have made. Go back in time and do it in the past. Pretend that this is today. Say, okay, well, I've done my analysis and I figured out that this is a line and this is a line and this is a line and these are the places I'm going to do. What I'm going to do now is I'm going to go ahead and I'm going to make my plan. Okay, I'm going to make my plan on paper. Not spending any money, making my plan on paper. And then what I'm going to do is I'm going to go ahead and I'm going to fast forward time. See, this is a luxury that you don't have when you're doing this in real time. You get to actually figure out just how bad you fucked up and how much money you lost. Or how much money you made without spending any money at all. It's like a time machine. We can just keep on going and it's like, oh, now what would I have done? Okay. And in this way, you can teach yourself how to make a plan that will make you profitable, that would have made you money in this market had you traded this plan. If you had planned the trade and traded the plan, how much profit would you have made? And so this is your homework. Go, find a chart, draw your support and resistance lines, and then do your dollar cost averaging on paper. Figure out how much money you could have made, and then move, by marching the chart forward in time. The point is to get to the point where you're drawing these support and resistance lines without drawing them, to where you can see that this is a correlated line right here. Here, 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 correlation, correlation, correlation. Without actually having to draw the line. It's practice. It's like any athlete. Any athlete is going to practice his art. And the practice that I'm asking you to do is to exercise the muscle above your head. Practice drawing these lines. And so that on Wednesday, when we come in and we try and we learn a whole new set of techniques, and I say, okay, but where's support and resistance? You just go, oh, it's right here, obviously. I can see it plain as day without even drawing the line. This is about muscle memory. It's about just having done it enough times, having drawn the lines enough times to see it. And then get out your notebook and start doing your dollar cost averaging calculations. Get out your old calculator and start figuring out how much money you made how much money you spent going down and how much money you made going up. Until you can do the dollar cost averaging in your head. Until it's so obvious to you where you would do your dollar cost averaging and exactly how much you spent so far without getting out the calculator. And when the notepad becomes tiresome and the calculator becomes annoying, the pain that you are feeling is telling you the change that is required. Perhaps a Google spreadsheet would make these equations easier. And so that's what we'll focus on next time, is we'll make us Google spreadsheet. We'll start tracking our dollar cost averaging and our profits and all these things in a much more refined way as we move on towards automating the whole thing. So I invite you to go and figure out your support and resistance and plan your trade and trade your plan. Because that is the way of the trader. Thank you all very much for attending, and I look forward to a lively discussion in the dojo following this. Good night, all.